I want to welcome everybody back to the Independent Investor channel. This is a very, very common question in investing. Should I own bonds? Should bonds take up a percentage of your portfolio? And the landscape has really changed on this. And I know historically, there's always been this interpretation or acceptance of the norm that a portfolio just has to have some bond exposure to it. And I don't mean to challenge or discredit that line of thinking, because historically the hybrid mix between the bond and the equity mixed portfolio has proven to be very successful over time. Okay. However, with the emergence of new products on the market and different schools of thought, I'm making this video by nature of a book that I just read, and it spoke to making sure that when you establish your long-term financial goals, that your portfolio is aligned to meet that goal. Okay. And it brings in the question of either owning bonds just to own bonds or owning bonds because it's going to help get you where you need to be down the line. And I think sometimes the latter gets a little bit misconstrued, in that people will put bonds in their portfolio and it's not really conducive to meeting your long-term goals. And in that particular case, if your portfolio is going to underperform based on the drag of fixed income in the portfolio, a lot would consider that planned failure, and that would go against what the traditional knowledge would tell an investor to have a well-mixed portfolio. All right. In this video, I'm going to talk about the 8 stocks that I invest in lieu of bonds. Okay. I've got just a little over $52,000 in these 8 names, that of which I'm going to provide to you guys both in the comment section of this video as well as the description of this video, so you guys don't have to memorize these picks, nor am I going to go in depth. This is really just to challenge the idea that you have to have bonds. Okay. And just to put this into context, my portfolio is around $471,000. Okay. The current allocation as an aggressive investor, like I am, somewhere in the middle between moderate aggressive and aggressive, puts me at a recommended allocation bond to equity exposure to about 10%. Okay. It calls for about an 88% exposure to equities and the remainder of 12% or 10% in bonds, and the remaining 2% to cash. Okay. So to give some context around what the recommended allocation is, in line with, again, traditional framework and portfolio building, etc., it calls for about a $40,000 bill to be devoted, split across short-term, intermediate term, and long-term bond exposure. Okay. Now, the issue with that is I don't want to own bonds. Okay. I've evolved. I have owned bond ETFs in the past, and I've done quite well with them. The unfortunate part about it is it's a very simple way of investing and tethering your money on the maturity of short terms, which are inside of 5 years, intermediate term 5 to 8 years, or 5 to 10 years, depending on the length and duration of the bond, and then your extended long-term duration, and then even you can go opt for the extended duration stuff, which is 20 plus. I don't like to do that, and specifically with the low interest rates now, it just doesn't seem conducive to me, nor is it, to my most important point, not in line with my portfolio building goals. All right. So I'm going to rip through these 8 holdings. These represent about a 4.868% dividend yield. One of these is a monthly dividend payer. The rest of them are quarterlies. They all have 2 things in common. One is I have at least 100 shares of them. Number two is I do write covered calls on each one of these. So just another aspect to think about when you're generating this income type of portfolio and you're looking for alternative plays rather than always defaulting to what is the norm, and that's owning bonds. The first offering is the one that I really think should go into a Roth IRA, and that is Realty Income Core, high dividend payer, monthly payer, give you some exposure to the real estate sector. But I own 156 shares of these. This is a tough one to write contracts against because the premiums really aren't that good. But I do own this in the Roth IRA because of the non-qualified status of the dividends. Okay, the next two that I do own are also in the Roths. The rest of them are in the taxable brokerage account, and I'll earmark those for you guys. So Pfizer is the next on the list to cover some health care. So unlike bonds, you're able to kind of diversify the portfolio. And a lot of these large companies are diversified within their respective businesses anyway. So it really just provides a nice alternative to seek even a higher dividend yield than what the fixed income yield can render, and give you some chance and crack at some capital appreciation and not be so tethered to the interest rate fluctuation, which are at record lows right now. All right. So Pfizer, they're on the list, over 4% dividend payer. Cisco, over a 3% dividend payer in the technology space. It's the only one that I've got on the list here. I was really trying to comb through the sectors and provide some examples from each of the sectors that you could dabble with to give you this higher than average yield and own in lieu of bonds. All right. And Cisco met the bill. I own 125 shares of Cisco, and I do write long-term contracts on that and collect the premium within the Roth. Okay. Leggett and Platt is in the discretionary sector. It's a good one, over 3% payer. I believe it is a dividend king, if I'm not mistaken. Very, very solid, very, very established company. It's been around for a long time, many, many years, and it really can be that proxy against owning bonds. Next on the list is AT&T, everybody's favorite. This is undervalued right now, in my opinion. Pays a 7% dividend, so it really helps embolden this yield that we're going through. But AT&T fits the bill. The next two on the list are actually out of utilities. They are my two favorites. You could opt for a utilities ETF if you wanted to do that as well in lieu of bonds. But just to kind of expand your horizons, both Duke and Southern Company, I own very large positions in, about 6,000 in Southern Company, and Duke Energy, I own about $10,000 in. So just in lieu of owning the bonds, I opt to own these regulated utilities, which in my opinion are some of the safest investments that you can move to now. These guys are money making juggernauts, and they've had established dividends for many, many years. I think Southern Company and Duke are both up toward a 5% yield. So very good there. And then finally, rounding out the list is Altria Group in the staples category, also a nice 7% payer in the space. So you guys can kind of see here, comparing apples and oranges, yes, but I think it really does help expand your portfolio building when you sit back and say, is our bonds one of those aspects of the portfolio that I want to try to build out? And then the more important question is, are the bonds going to help me reach my strategic goal? The whole point of investing is to reach your financial goal. Okay. It's not just to invest to invest. And I think traditional lines of thinking would have, absolutely, of course, you need to have a mix of bonds in the portfolio. And I think for some investors, that's absolutely appropriate. But if you're looking for somewhat of an alternative play, the way I seek out my exposure, go after a little bit higher dividend yield, certainly. and have some potential there for some capital appreciations, and own in the portfolio in the capacity that I do to write premium contracts against. It just makes total sense to me, and it's much more of a lucrative investment than just putting bonds in the portfolio to put bonds in the portfolio. Guys, thank you so much. Tune into the message and make sure and subscribe to the channel. Leave your comments at the bottom. I will leave this portfolio of 8 stocks mentioned in this video in the description below for you guys to review at your leisure. Share the message with those folks. Bring them onto the community. Have them join the independent investor community, looking to empower one investor at a time. Guys, thank you so much for tuning into the message, and good luck in your investment future.